Let's talk about the dot-com bubble of the 1990s. It's a wild story, really, about a future that felt like it had finally slammed into the present. A moment of unbelievable optimism that spiraled into one of the biggest economic disasters in modern history.
You have to picture the 90s. The whole decade was just buzzing with this new energy. The internet was here, and it promised to connect every single person on the planet. For the first time, it really felt like anyone could change the world right from their keyboard. This wasn't just about new businesses, it was about building a whole new world, a cyberspace, totally free from the old rules and limits of reality.
But oh man, that dream came with a jaw-dropping price tag. When the bubble finally burst, it wiped out an estimated $5 trillion in value. That's trillion with a T. Thousands of companies just vanished. And along with them, the life savings of countless everyday investors.
So that's the big question, right? How did this happen? How did some of the smartest people in the world get so completely swept up in a frenzy that, looking back, seems so obviously destined to fail? Well, let's unpack that story.
Here's how we're going to break it down. We'll start with how that digital dream crashed back to Earth. Then we'll look at the recipe that created the bubble in the first place, explore the incredible psychology of all the hype, watch the moment it all burst, and finally, see what lessons we can learn from the wreckage.
Okay, so first, that initial dream. The internet wasn't just seen as a new piece of technology. For a lot of people, it was a new frontier, a digital escape. People genuinely believed you could be anyone you wanted, build whole new worlds with just the click of a button. It was this powerful, almost utopian vision.
But the crash completely shattered that illusion. Turns out this new cyberspace wasn't an escape at all. Nope, it was just an extension of the same old real world, complete with the same old problems. Greed, hype, and, well, really bad business models. And this realization just led to a huge loss of trust in this whole new digital thing.
So what ingredients actually came together to create this massive bubble? It really boils down to two key things. You had the economic fuel that fed the fire, and then you had the technological spark that lit the whole thing up.
First, let's talk about the fuel.
In the mid-90s, the US Federal Reserve lowered interest rates to get the economy going. What that means is, borrowing money was cheap, and investors suddenly had a lot of extra cash on hand. And you know what happens when people have more cash? They get a lot more willing to make some risky bets. Then came the spark, and wow, 1995 was a huge year. Windows 95 came out and made personal computers genuinely easy for anyone to use. At the same time, the internet became commercially available to the public. And then, a web browser company called Netscape went public on the stock market, and its success was absolutely explosive. Netscape's massive IPO was basically the starting pistol for a full-blown frenzy. Investors saw that success, and it kicked off a digital gold rush. It got to the point where, and I'm not kidding, if your company name simply ended in .com, venture capitalists would literally throw money at you. We're talking about companies with zero revenue, sometimes not even a finished product, getting valued at hundreds of millions of dollars, all based on the sheer promise of the internet.
And this is where the story gets really human. See, the bubble wasn't just about money and technology, it was about psychology. It was a time when pure hype completely steamrolled rational thinking. The key idea here is something called speculative investment. This is when the value of something isn't based on concrete facts like profits or quality, but on subjective feelings, on opinions and hunches about what might happen in the future. It's basically about betting on popularity. Think about it this way. Traditional investing is kind of like your retirement account. You're looking for lower risk for slower, steadier returns over time. Speculative investing, that's a high-risk, high-reward gamble. You could make a ton of money fast, or you could lose every single penny. And during the dot-com era, almost everyone was playing that high-risk game.
Investors were suffering from what you could call digital myopia. It's like they had tunnel vision. They were so mesmerized by the short-term growth and just how new and exciting the internet was that they completely ignored the fundamentals. They weren't asking, is this a sustainable business? They were only focused on how fast the stock price was going up.
This quote is a perfect analogy. I mean, why is a famous painting worth millions? Because people agree that it is. That's it. Dot-com stocks in the 90s were valued the exact same way. Their insane valuations weren't based on profits, they were based purely on the collective belief that the internet was the future.
Well, as we all know, bubbles don't last forever. The dot-com party had to end, and when it did, the crash wasn't just inevitable, it was brutal. So what finally popped the bubble? It
It was really a perfect storm of factors. The Fed raised interest rates, which made money tighter. Big companies stopped spending a ton of money after the whole Y2K bug scare was over. And crucially, investors finally started to realize that many of these dot-coms had no actual plan to ever make money. And that's when the panic selling started, almost overnight.
Pets.com is the classic, almost comical example. They were famous for their sock puppet mascot that even had a Super Bowl ad. The thing is, the company spent a fortune on advertising but never solved a very basic problem. It cost them $25 to ship you a $20 bag of dog food. It was the poster child for the era, along with companies like Webvan, which burned through over $1 billion trying to deliver single grocery orders, or Cosmo.com, which promised 1-hour delivery of a pack of gum for free. They were all catchy ideas with totally broken business models.
The crash was just incredibly swift. The market hit its absolute peak in March of 2000, and then for the next 2 years, it was in total freefall. Dot-coms that had been worth hundreds of millions of dollars just, poof, vanished. Then other major events, like the Enron scandal and the 9/11 attacks, just made the economic devastation that much worse.
After all that chaos and destruction, it's pretty easy to ask, was it all just a colossal waste of time and money? Well, not entirely. There were some incredibly powerful, if painful, lessons learned from all that wreckage.
You know, in the early 2000s, .com basically became a dirty word. People were deeply skeptical of any online business. And this really isn't so different from how a lot of people view things like cryptocurrencies today. A few bad actors or questionable projects can end up tarnishing the reputation of an entire industry.
Ultimately, the bubble taught us a really hard lesson about hype. It showed us that we just can't make huge, life-altering financial decisions based on things we don't fully understand. It's a powerful reminder to be patient, to do your homework, and to resist the urge to get swept up in the next gold rush.
But here's the funny twist in the story. The internet did eventually change the world. With the rise of things like social media and streaming and e-commerce, it finally became the useful, revolutionary tool that everyone in the 90s dreamed it would be. It just needed time to mature and for the actual business models to catch up with the vision.
And that really leaves us with a final thought, doesn't it? The struggle between hype and real, sustainable value, it's a constant battle. And when you look at the investment trends of today, it's worth asking ourselves, are we actually learning the lessons from the past, or are we just finding new bubbles to inflate?